Audit Planning and Fieldwork Part 2.
There are two types of audit risk. There are audit risk and business risk. I wonder, what is audit risk? Audit risk is the risk that arises from carrying out audit work. It is the risk of the auditor suffering loss as a result of giving an inappropriate audit opinion. It is related to materiality because it is the risk when the auditor comes to an invalid conclusion in audit report, such as the audit report is unqualified but subsequently material error is found in the financial statement, or the audit report is qualified but subsequently no material error is found in the financial statement. The first situation has a greater audit risk as it occurs more frequently and there is greater risk of the auditor being sued for negligence compared to the second situation. Audit risk may arise from not gathering appropriate audit evidence, being deliberately misled by those providing the evidence who conceal evidence that would have led to a different opinion, or who falsify evidence or misinterpreting, drawing inappropriate conclusions from the evidence gathered.
Next, we are moving to business risk.
Hey, do you know what is business risk?
Business risk is a material error occurring in financial statement and it is affected by the nature of audit client business, changes in state regulation, increased competition in market and changes in economy condition of the state. Business risk is the risk that the business will fail to meet its objective. The main components of business risk are financial risk, operational risk and compliance risk.
So is there a way to detect business risk?
Yes. Through pest analysis and also SWOT analysis.
In conclusion, audit risk is the risk of forming an incorrect opinion on the financial statements, and business risk is the risk arises throughout the whole operation of the business. Let's move to audit risk model.
The total amount of risk associated with an audit is determined by the audit risk. The audit risk may be considered as the product of different types of risks which may be encountered in the performance of the audit. The auditor must assess the level of risk pertaining to each component of audit risk in order to keep the overall audit risk of engagements below the acceptable limit. The calculation of the risk are: audit risk equals to inherent risk times by control risk times by detection risk. There are three types of audit risk, namely inherent risk, control risk, and detection risk. So what is inherent risk? Inherent risk is related to the traits that may cause material misstatements arising due to error or omission in the financial statements. Factors applied in assessing inherent risk are nature of the client's business, integrity of the management, client's motivation and client's knowledge of accounting standards. What about control risk? Control risk is a risk where a client's internal control failed to prevent or detect the material errors or misstatements in the account balance. Control risk exists attributable to the inherent limitation of internal control system and inadequacy of the segregation of duties, such as the human error or faulty judgment. As for detection risk, is the risk that occurs when the auditors fail to detect remaining material misstatements in the financial statements after assessing inherent risk and control risk. The auditors must apply audit procedures to detect material misstatements in the financial statements, whether it is due to fraud or error. As an auditor, we are too busy and examine the financial statement. That's why we have audit sampling. What's audit sampling? Audit sampling is an application of audit procedures in the process of selecting the right sample in order to form or assist in forming a conclusion concerning the population. What it can do? 1. The auditor will finish on time. 2. The auditor conclusion will supported by reason. 3. The auditor can compile the evidence together. 2 types of sampling approaches. 1. Selected method. 2. Sample size. Selected method have 2 different part. Selecting all item. And selecting a specific item. By selecting all item, usually for small value, and all the transaction will be examined. While by specific selected, it is used for large value and only few will examine. Sample sizes. Think to choose the right size of sample to reduce the sampling risk. Sampling risk where the conclusion from wrong sample. Sampling error is risk on the sample that leads to mislead decision. Non-sampling risk that cannot be recognized by the auditor. Representative sampling, sample equals real one, very close. Under sample size. Statistical. Non-statistical. Statistical, it is complex and it uses mathematical solution that will lead to strongest efforts. This will be practiced in a large company. Non-statistical is easy to use because it did not use computation as statistical had. This lead to weak defense. This method being used by small company. Method. For statistical we have 1. Randomly. Choose using number or computerized. 2. Systematic. Based on internal size. While non-statistical. 1. Haphazard. Free from bias. 2. Blocking. Choose sample by day, month, year as the basis. 3. Judgment. Choose selectively. Evaluation of sample size are test of control and substantive test. Test of control is to make sure the work done efficiently, while substantive test is detecting misstatement in the statement when there is a problem occur. What if there is an error? What we hack equals V to do is 1. Modify the audit procedure. 2. Consider the effect of error in the audit report. 3. Recommended the management to identify the error together. The end. Thank you.